Critical update alert. This is breaking news. If you're an avid XRP investor, this could be the moment that decides whether you're chasing wealth or building it. And in these next 90 seconds, you're going to want to hang tight. Otherwise, you may miss highly valuable information. Make sure that you like and subscribe this video. It really helps me get the message to the masses and is greatly appreciated. Now here's the deal. What I'm about to share with you isn't just another crypto headline. It's the intersection of global debt markets, collapsing monetary systems, and a digital asset sitting right in the middle of it all. And if you hold XRP, every detail matters. This is not financial advice. Always do your own research, consult with licensed professionals, and never risk more than you can afford to lose. For context, XRP is trading $3.09 at the time of recording this video. And if you're watching this later, price may have shifted, but the mechanics I'm about to walk you through don't change. Let's zoom out for a moment. The global financial system is creaking under the weight of debt. U.S. national debt has surpassed $40 trillion, with annual interest payments alone larger than the Pentagon's budget. Japan is trapped in a carry trade unwind worth over $10 trillion, where cheap yen-funded bets are threatening to collapse under rising rates. And the bond market, the foundation of global liquidity, is showing signs of fragmentation at levels we haven't seen in decades. If you've been paying attention, you know that when bonds break, everything breaks. Equities, currencies, housing, even commodities. So where does XRP come in? To answer that, you need to understand the mechanics of liquidity. Right now, trillions of dollars flow daily through outdated payment rails like SWIFT. Transactions take days, settlement risk lingers, and liquidity corridors remain fragmented. Enter RippleNet, on-demand liquidity, and the XRP ledger. These aren't just buzzwords, they're the scaffolding for a new financial order where value moves instantly, 24/7, across borders. And here's the kicker. Ripple and its allies have been quietly aligning with the very institutions that hold the keys: central banks, the IMF, BIS, and major custodians. But let's get sharper. What happens when debt stress forces a reset? Governments have three choices: inflate it away, default, or restructure. History shows us that when debt to GDP ratios explode, resets are inevitable. 1933, FDR repegs gold. 1971, Nixon ends the gold standard. Each reset revalues assets overnight. Now imagine the US Treasury and global institutions using XRP as a bridge asset in a new monetary framework. Suddenly, XRP isn't just a speculative token, it becomes liquidity infrastructure. And price isn't about hype, it's about necessity. Think about it like this. If even 1% of global cross-border flows, a multi-hundred trillion dollar market, requires XRP as a bridge, structural demand skyrockets. Supply on exchanges is already shrinking, with custody absorbing billions and ETFs waiting in the wings. The stage is being set for price discovery that doesn't look like retail pumps, but like institutional repricing. The gap-up kind. The kind that never revisits old levels. Now here's where most people get blindsided. They think in terms of retail bubbles, $5, $10, maybe $20 XRP. They'll sell too soon, hand over their bags, and institutions will hold for decades. The reality is that XRP's design, fast, scalable, liquid, makes it the perfect utility reserve. And when governments face existential crises over debt, they reach for tools that work. XRP was engineered for this moment. But stay with me, because in the next section, we're going to break down how the carry trade unwind in Japan could be the trigger that flips this switch. We'll look at the mechanics step by step, and I promise you, if you hold XRP, the next 90 seconds will be the most important context you'll hear this week. Here's how the unwind actually happens step by step and why it matters for your XRP positioning. The yen carry trade is simple on the surface. Borrow an ultra-low rate yen, convert to dollars or euros, buy higher yielding assets, pocket the spread. It worked for years because Japan's rates stayed pinned and the yen stayed weak. But when the yen strengthens or global rates fall, the math flips. Traders rush to close positions, selling the assets they bought abroad, buying yen to repay yen debt. That wave of forced buying can supercharge yen strength and drain liquidity from everywhere else at once. Picture a line of dominoes. First, leveraged funds dump US and European bonds to free up cash. Then algorithms sniff the stress and pile on, pushing yields unstable. Equity desks hedge, volatility spikes, margin calls hit, dealers widen spreads. Suddenly, what looked like a benign rebalance turns into a dash for dollars and yen at the same time. Liquidity hides. When that happens, settlement frictions on legacy rails get exposed. Messages fly, money crawls. That's the moment when rails matter more than narratives. Now layer in the Bank of Japan. If the BOJ hints at tightening or adjusts yield curve control, the risk-free assumption behind the carry cracks. Japanese megabanks and insurers rebalance out of foreign assets, corporates repatriate, and the yen's surge magnifies unwind pressure. Central banks can slow this with swap lines and jawboning, but they can't erase the plumbing issue. Fragmented liquidity corridors that settle in hours or days, not seconds. This is where real-time, pre-funded liquidity loses to real-time, on-demand settlement. In stress, treasurers care about certainty, netting, and finality. They want to compress settlement windows, reduce trapped capital, and move value across time zones without waiting for daylight banking hours. That is precisely the gap utility assets can fill. Enter the Japan nexus. SBI's multi-year alignment with Ripple, BOJ's explorations around digital rails, and the broader Asia corridor experimentation with tokenized value create a practical testbed. Imagine a corporate in Tokyo settling a large USD invoice to Europe on a Friday close. In a carry unwind, USD liquidity is tight and spreads are ugly. With messaging alone, you wait. With on-demand liquidity, you route. Yen converts to XRP in seconds, bridges into euros with price discovery native to the path, and final settlement lands before the legacy window even opens. No nostro pre-funding, no stranded cash, no weekend dead time. Scale that from a single corporate to a network of banks, PSPs, and market makers maintaining XRP liquidity pools across JPY, USD, and EUR pairs. When corridors seize, these pools function like shock absorbers. They don't eliminate volatility, but they reduce the need to hoard working capital everywhere at once. The fewer dollars a bank must pre-position in foreign accounts, the less it contributes to dollar scarcity during stress. In other words, better rails don't just move money faster, they reduce the system's reflex to freeze. I want you locked in for the next 60 seconds because this is the hinge. In a true unwind, the winners are the rails that compress settlement risk the most. If SWIFT evolves into shared ledgers that still require external liquidity, it remains information first. If banks need an actual bridge asset to complete value transfer without pre-funding, they'll pick the network with the deepest, most reliable liquidity that clears instantly. That's not a meme contest. That's an operational decision. The more corridors that lean on XRP when spreads blow out, the more recurring demand concentrates in the asset itself. Liquidity begets liquidity. Price begets deeper books. Deeper books attract institutional rooting. That is how utility turns into price discovery that doesn't care about retail timelines. Let's connect the dots from order to chaos. In the orderly scenario, policymakers telegraph changes, funds unwind gradually, and bid-ask spreads stay sane. Even here, treasurers still prefer instant netting. Utility assets gain share because they make CFOs' days easier and cheaper. In the chaotic scenario, policy shifts or an exogenous shock force, synchronous de-risking. Dealers step back, collateral calls cascade, and settlement delays get expensive. That's when routing through tokenized FX and bridge assets jumps from innovation pilot to we need it now. Each crisis onboards a new cohort permanently. Global spillovers, bonds first. Dealers' inventory gets constrained, duration hedges jump, and equity multiples wobble as real yields twitch. FX next. Dollar strength squeezes EM borrowers. Yen strength forces more unwind. Commodities soon after as financing and trade credit tighten. In every leg, the pain point is the same. Too many obligations stacked on messaging pipes that weren't built for continuous atomic settlement. The fix isn't another memo. It's rails that deliver finality across ledgers in seconds. Zoom back into Japan. A digital yen doesn't replace the need for bridges. It increases it. CBDCs are domestic by design. They still need neutral highways to interoperate. If BOJ, through public-private collaboration, prioritizes 24/7 cross-border connectivity, a neutral bridge with proven throughput becomes indispensable. Institutions don't want to warehouse every currency. They want smart access to pooled liquidity. XRP pools across JPY, USD, EUR fit that bill, provided governance, compliance, and reporting meet bank-grade standards. That's why board-level alignment and enterprise integrations matter as much as code. They're the permissioning layer that lets big money touch new rails. Let's talk mechanics inside a bank. Treasury sets intraday and overnight liquidity buffers for each currency. In a volatile week, those buffers spike, starving other desks of capital. If a bank can offload part of that buffer into programmatic access to external liquidity, convert, route, settle, replenish in minutes, it frees capital without raising risk. Do that across multiple banks, and you've reduced systemic pre-funding. Reduced pre-funding means less forced selling when volatility hits. Less forced selling means shallower drawdowns, faster recoveries. Utility rails change market microstructure. What about market makers? In calm markets, they quote tight spreads because inventory risk is low. In panics, they widen or step back. With continuous low slippage pathways between fiat pairs via XRP, inventory turns faster, so spreads don't need to blow out as much. That doesn't erase shock, but it smooths it. Smoother markets invite more flow, which feeds back into deeper pools. This is how corridors graduate from experimental to mission critical. Now anchor this to your bag. If adoption curves bend during stress, supply on exchanges becomes the choke point. Custodians, banks, and funds don't flip assets in retail venues. They lock them in cold workflows, SLAs, and internal controls. Every basis point of flow that shifts to instant settlement rails increases the incentive to hold operational XRP inventory, not to flip, to use. That's a structural sink for float. If you're thinking like an institution, you accumulate before the system admits it needs you. If you're thinking like retail, you sell the first ramp and watch institutions take your seat. Give me one more minute, because here's the pivot that most miss. Even if Swift's shared ledger pushes the industry forward, it still needs neutral liquidity to bridge asset types and time zones. Messaging alone doesn't reduce value at risk, settlement does. The asset that proves it can clear size, on time, across jurisdictions with auditability and compliance hooks, is the asset that graduates from speculation to infrastructure. That transition is not a headline. It's a series of routing decisions that, once made, don't reverse easily. Before we move on, quick reality check. None of this requires a grand conspiracy, a single switch flip, or overnight laws. It requires pain in the old system and relief offered by the new one. Every time the carry trade buckles, every time dollar funding gets tight, every time cross-border treasurers scramble, the incentive to adopt better rails increases. And once those rails carry real value, the asset that powers them becomes scarce by design. Stay with me, because in the next section we're going to quantify the liquidity picture, shrinking exchange balances, potential ETF absorption, and how custody workflows permanently reduce circulating float. I'll also give you the shallow lake model so you can visualize why thin surface liquidity leads to violent repricing when a big hand reaches in. Here's the hard truth about liquidity that most people don't factor into their decisions until it's too late. Surface liquidity, the stuff you and I see on exchanges, is a thin film floating on top of a much larger body of locked, custodial, and programmatic inventory. When price is calm, that film looks plenty thick. Order books appear deep, slippage is low. But in a real move, the lake isn't deep at all. It's a shallow basin with rocks just below the surface. One large scoop from an institution, a custodian rebalancing, or an ETF create absorbing flow, and suddenly levels vanish. That's why the same amount of capital that once moved price a little can move it a lot later in the cycle. Shrinking exchange balances are the first tell. Over time, coins migrate off retail venues into cold storage, prime brokerage, and bank-grade custodians with strict access procedures. Those tokens don't dance with every headline. They're slotted into workflows with compliance, reporting, and service-level agreements. Translation: they don't come back onto exchanges just because price ticked up. The float that remains becomes the entire battlefield for price discovery. If you've ever watched a chart gap through levels without trading much in between, that's the shallow lake effect in real time. Now layer on institutional absorption. Whether it's structured products, SMAs, or future ETFs targeting utility assets, professional wrappers convert free-floating coins into owned but immobile supply. The wrapper matters because it changes the decision maker. A retail wallet holder can panic sell on a Sunday night. A fund with a prospectus, a custodian, and an investment committee does not. That governance slows the reflex to sell and effectively tightens tradable float. Even without a headline ETF, the institutionalization of custody achieves a similar outcome: steady bid, sticky supply. The custody workflow itself is a quiet black hole for float. Imagine a bank or PSP routing cross-border flows that require operational XRP inventory. Treasury procures a base amount, adds a buffer for volatility, then sequesters it with signers and controls. That inventory rotates, but it doesn't sell. It fuels corridors. The better those corridors perform, the more inventory gets earmarked. As corridors proliferate across JPY, USD, EUR, GBP, and remittance routes, operational holdings scale with volume. Utility doesn't just create demand spikes, it creates permanent sinks. Let's talk microstructure so you can spot this before the crowd. In the early phase, you'll see shallow pullbacks and fast recoveries as resting bids absorb dips. Market makers quote tighter because inventory turns quickly via bridge flows. Then comes the awkward middle. Volatility increases as books thin out at obvious levels. Wicks get longer, gaps more common. People call it manipulation, but most of the time it's just insufficient standing inventory to absorb new size. Finally, you get the stair-step repricing. Impulsive bursts up, short consolidations, then another burst. Old resistance doesn't act like resistance because the sellers who lived there moved their coins to custody months ago. Price isn't climbing a ladder, it's crossing empty rooms. Now don't miss this next 60 seconds. This is the leverage point almost nobody models. When utility usage grows, the marginal buyer isn't a trader, it's an operator. A PSP, bank desk, or fintech with live volume will buy because the rails require it, not because the chart looks good. Those purchases don't pattern match retail cycles. They show up on Tuesdays at 11:13 a.m. because that's when inventory thresholds trigger, regardless of sentiment. Each threshold-driven buy drains available float at the worst possible moment for shorts and the best possible moment for repricing. The more corridors that turn on, the more threshold buyers exist, and the more often depth disappears exactly when you think it won't. Think in buckets. There's tradable float, there's operational float, and there's strategic float. Tradable float is exchange inventory plus hot wallets. That's the shallow lake. Operational float sits in custodians powering corridors. That's the plumbing. Strategic float belongs to long horizon allocators who made a mandate decision. That's the vault. Price is set at the margin where tradable float meets new demand. The moment operational and strategic buckets expand faster than replenishment, tradable float thins and price becomes hypersensitive to flow. This is where psychology and structure collide. Retail imagines a smooth ramp so they can sell into strength and buy back lower. Institutions don't give you that rhythm. They ladder in with algorithms, park inventory, and shut the door behind them with governance. By the time headlines catch up, the bid has already moved higher, and the supply that would have met it is locked. That's why you see late-stage chasers stacking market orders into air and then complaining about illiquidity. It isn't broken, it's repricing to reflect the new, smaller float. Picture the shallow lake one more time. Sun's out, water looks calm, you can see the bottom near shore. A tour bus pulls up, that's a new corridor going live or a fund mandate approving allocation. 50 people step to the edge and scoop water at once. The shoreline drops by inches, rocks appear, and anyone standing there realizes the footing isn't what it looked like. That's the moment candles get violent. If you've ever wondered why blow-off tops don't revisit origin for years, it's because the shoreline moved. The water level, circulating float, didn't magically refill. It stayed lower while new structures were built at the higher watermark. To make this practical, watch three tells. First, exchange reserve data trending down while custody balances trend up. Second, longer settlement windows on large over-the-counter blocks, a sign that sourcing size requires time. Third, persistent basis in derivatives where futures trade at a premium that doesn't close easily, which often signals constrained spot supply meeting structural demand. These aren't perfect signals, but together they map the lake. Give me one more minute and I'll connect it to your decision-making. If you plan like retail, you think in price targets. If you plan like an operator, you think in inventory thresholds. Operators ask, how much do I need to run the rails? They buy at levels that make P&L sense for the business, not based on RSI. Strategic allocators ask, what exposure size meets mandate? They don't trade around it. They rebalance quarterly. When those two groups dominate marginal demand, your old playbook of sell the pop, buy the drop gets shredded by gaps. The drop you're waiting for never prints because the bids live higher now, and the coins that would have satisfied them are in the vault. This is also why consolidations feel different late in a cycle. Instead of broad rolling tops, you'll get tight flags that resolve higher with little warning. The crowd interprets tight ranges as indecision. In reality, they're often rationing, the market negotiating who gets filled before the next floor establishes. If you see volume drying into a range while exchange balances keep falling, it's not apathy, it's a handshake before the next step. All right, you've made it this far. You stay with me for the next 60 seconds because this is the setup that ties the whole series together. Liquidity crunch turns into utility scaling when corridors actually carry size on new rails. Utility scaling turns into institutional dominance when banks, custodians, and funds formalize inventory and move it beyond the reach of day trader supply. That's the three-phase transition from speculation to structure. If you understand where we are on that curve, the noise fades and the plan gets simple. Position before thresholds trigger, not after. In the final section, I'm going to put XRP side by side with Bitcoin and Ethereum so you can see why each serves a different mandate, map the macro tailwinds that historically coincide with aggressive repricing, and close with the exact behavioral traps that cause most holders to exit too soon. Give me one more round, because the last piece is the lens that separates those who ride the reset from those who watch it happen. Bitcoin, Ethereum, and XRP are always thrown together as if they're comparable, but in truth, they play completely different games. Bitcoin is digital scarcity, Ethereum is programmable economies, XRP is liquidity infrastructure. That's not a slogan. That's the reality institutions are weighing right now as they decide where to allocate trillions of dollars. Bitcoin has the brand advantage. It's gold 2.0. It's the hedge against monetary debasement, and it commands trust simply by surviving for more than a decade. But its limitations are built in: capped supply, slow settlement, and energy intensity. That makes it a store of value, not a settlement tool. Institutions hold Bitcoin the way central banks hold gold, as a reserve, not as the plumbing. Ethereum thrives on its versatility. Billions of dollars are locked in smart contracts, NFTs, and DeFi protocols. It's like the App Store for digital finance. The innovation never stops, and developers flock to it because it's fertile ground for experimentation. But that versatility comes at a price: congestion, fees, and a constant tug-of-war over scaling solutions. Ethereum is about ecosystems, not rails. XRP, however, is different. It was engineered from the beginning not to hoard value, but to move it. Its purpose isn't to be gold or an operating system. It's to be the invisible bridge, the neutral channel that connects fractured financial systems into one seamless web of liquidity. And that difference is why the next phase of XRP's journey won't be another retail hype cycle. It will be an institutional repricing event. Zoom out and look at the macro backdrop. Rate cuts are looming, debt spirals are accelerating, and liquidity cycles are turning. When markets get squeezed, institutions look for asymmetric upside. Assets that don't just preserve value, but multiply it under stress. Bitcoin will absorb some of that demand. Ethereum will too. But XRP's edge is its role as a settlement asset. Settlement is not speculative. Settlement is mandatory. That's why it stands in a category of one. Picture the phases of this transition clearly. First is the liquidity crunch, where exchange balances keep thinning and shallow markets amplify every buy. Second is utility scaling, where corridors actually carry real size, and operators need XRP, not because it's trendy, but because their rails demand it. Third is institutional dominance, where ETFs, custodians, and treasuries lock away billions of tokens, taking them out of circulation permanently. Those three phases are the recipe for structural repricing, and here's where psychology becomes the trap. Retail holders will celebrate at $5, panic at $10, and sell at $20 thinking they've made generational wealth. In doing so, they'll hand their coins back to institutions that plan to hold them for decades. That's the cycle of transfer. The impatient get their short-term gains. The patient graduate into the new 1%. Now don't miss this. Give me 60 more seconds, because this is the part that cements why the story is bigger than any chart. When global settlement starts running on XRP, the token doesn't just moon and retrace like altcoins. It locks into new floors. Think of it like tectonic plates shifting. When two plates grind, the landscape above them changes forever. The valleys and mountains aren't temporary, they're permanent. That's what institutional repricing looks like. The calm right now is deceptive. Order books seem stable, volumes seem manageable, and most believe they'll have time to adjust. But that's not how these transitions happen. History shows us that the biggest financial resets don't give countdowns. They give shocks. Bretton Woods, Nixon closing the gold window, the 2008 liquidity crunch. None of them unfolded gradually. They flipped the system almost overnight. XRP's role in settlement means its repricing, when it comes, won't ask your permission either. So here's the final lens to lock in. Bitcoin will remain the digital gold. Ethereum will remain the digital economy. But XRP is the blind side. It's the piece most underestimate, the one institutions are quietly aligning around, and the one asset designed to sit at the center of real-world settlement. That's not a trader's narrative, that's a system narrative. And let me leave you with this. If you've made it this far, you've seen the logic, the mechanics, and the psychology. But the reveal is simple. We are living through the calm before a generational storm. The rails are being laid. The liquidity is being drained. The institutions are positioning. And when the switch flips, you'll either already be standing on the right side or you'll be chasing shadows of prices that never come back. So ask yourself one question tonight. When the silence breaks and the floodgates open, will you be holding enough? Because history won't wait for you to decide. Make sure that you like and subscribe this video. It really helps me get the message to the masses and is greatly appreciated. Have a wonderful evening, my brothers and sisters. See you again on the next one.